Let us now move on to another very exciting session where Mr. Sanjeev Aggarwal, co-founder, the Fundamentum Partnership and Helion Ventures will be addressing on a very important aspect, that is, what do investors look for in an edtech startup? He is a veteran investor and his investment firm's portfolio companies include startups like Byju's, Topper, Simply Learn, Big Basket, and many other well-known startups. May I now invite Mr. Sanjeev Aggarwal for his keynote address and Mr. Rajendra Singh Pawar to moderate the session and take up the questions from the audience for Mr. Aggarwal. May I request the audience to type in their questions in the chat box. They will be answered at the end of this session. Over to you, sir.
Sanjeev, very, very hearty welcome to you.
Thank you, Raji.
So now you've been introduced well, but I just want to say that you did a great stint in the software industry, then you did your own startup. You've been good friends since then, and you got into the edtech area very, very early. I would say too early. At that time, and I warned you about the risk because infrastructure wasn't ready. But I have to say you were a pioneer and you had your experiences. So after you made your comments for about 15 minutes, we'll start with a few questions, and I will put some of the questions about the early phases as well, because things have changed and now you're becoming a big investor. So first of all, if you would take about 15 minutes and make your opening comments on the topic that we have for you, which is, what do investors look for when they look for edtech startups?
No, I think that's a great topic. Thank you for getting me on this show, Raji. And I'll probably say that there are really two M's in our industry. One M being the management and other M being the market. So let's tackle both of these separately. I think in terms of management or founders, there are a few characteristics that we look for. And one of them being, do you have the staying power to go all the way? Because investors make money if company reaches $1 billion valuation. And we know that in India, it takes at least a decade to build $1 billion, to take investor capital and leave the task unfinished, then that is bad news for investors. So I think staying power is probably first part of selecting the founder. The second piece, I think, which is true for entrepreneurship across all sectors, not unique to edtech, is that do you have good first principles thinking? And the reason for that attribute is that starting any company is a question of a lot of ups and downs, navigating ambiguities and readjusting your path. So if you come with a template of success, then that probably is very one track. And if you experience turbulence, then you are not able to steer the ship in the right direction. So investors do look for first principle thinkers who can navigate the market as they discover what's coming next. The third, I think, attribute is to build $1 billion business, which is what investors look for. Is your aspiration greater than resources? because if you're setting out to build $1 billion in valuation, you probably need $200 million in capital, and nobody's going to give you that money upfront. But if investors feel that you have the ambition to build a world-class, large-scale company, then the probability of attracting talent, attracting capital, all those things become much easier. And therefore, I think the aspiration should reflect in your thought process very early on in the innings, as that becomes the beacon for all the constituents that are looking at you. And then the other one that comes to the top of my mind is customer centricity. I think one attribute or one characteristics of tech businesses are that they take a lot of capital for customer acquisition. And if you acquire customers and you lose them, then your business almost becomes unviable. So how you go about acquiring customers and then through word of mouth acquiring next set of customers is a prerequisite to building a profitable company, I think is a very important part of who you are. So I think entire company being customer backwards is a test that every investor would do by talking to your customers that you have already acquired and hearing them what they say. In our industry, one metric which is very prevalent is NPS, which is Net Promoter Score, which means how many of your customers are your promoters and how many of your customers are your detractors. So promoters minus detractors is your Net Promoter Score. And a high Net Promoter Score is a very good way of building an enduring company, and therefore is something that investors look for. And probably if I were to mention an additional one, it probably would be complementary skills. We like to say at Fundamentum that any company anywhere in the world is built by what we call a Brahma and a Vishnu. Brahma, who is very forward-looking and is the visionary, and Vishnu, who kind of keeps the shop running or maintaining the universe. And we've also found through a lot of our investing experience over the last 2 decades that it can't be the same person. So it will generally have to be 2 different people. So in a way, it's a combination of CEO and COO. And when they recognize each other's strengths and come together, then the magic happens. So I would say those would be some of the characteristics that we look for in a founding team. I think the things that we look for in the other M, which is market, is that it should be about $10 billion in addressable size. Because what we have found is that $10 billion, and if you take 5% market share, yields $500 million of revenue. And if you get value 2 times revenue, then you yield $1 billion business. So that is a cut that investors would apply, that are you participating in a market which is about 10 billion, and hopefully a market which is very diffused, which means that you are not dependent on very few set of customers. So preferably a consumer business where there is no single customer concentration. And I think an early mover advantage. So you can be probably in the first three, but in the tech businesses, after number three, the long tail doesn't really create any value. So you shouldn't be too late to the party. I think if you are within top three, then you are fine. So timing becomes important. And some other aspects of business would be that you should be preferably building a single line of business, because resources are very scarce in your early years. So if you have started multiple divisions, then it shows that you have still to figure out your product market fit. So I think a single line of business and all wood behind one arrow is something that investors like a lot. In later years, you can begin to add new lines of adjacencies. But in the initial years, I think you should be very sharply focused on building a very sharply focused business. And I think the other important characteristics of your business has to be very high gross margin. You may not be profitable because you're investing in SG&A and marketing, but you should have high gross margin, which means your direct cost should be much less than your pricing. And that to an investor indicates that over long haul, you will be able to build a profitable company once your SG&A is amortized over a larger revenue base. But in the earlier years, I think the test of your business is that does it yield high gross margin and high growth. And I think last but not the least, creating a high quality culture. And the reason for that is very simple. India is talent constrained. So everybody is in the market to look for talent. And good talent goes to companies that have outstanding culture. So it has a direct impact on scalability. If you have great work culture that people want to come and work with. So those would be, Raji, some of my initial thoughts on what it takes to build an enduring company or what investors look for in an edtech startup.
So that's a ton of wisdom right at the start. So a couple of questions. We may not be able to cover all, but still have 12 minutes. So now, we are currently in edtech, at least we have more money chasing, currently less ideas. So in a sense, we have a situation where good startups may have to make a choice of who to go with and who to work with, not just the other way around. So if a startup has a very good idea and they now need to choose who should be the investor they choose, what would be good tips for them to have?
I think that's a great question. First, you should see if they have a long-term horizon like yours. So if you are building for long haul, are they also in it for long haul, or will they sell during the middle of your journey? So I think that is one aspect. Second aspect is the chemistry with the board member. The person who is evaluating your project is likely to be your board member. And how do you feel about that board member in terms of alignment of interest, in terms of cultural fit? I think that would be an important aspect. Some indication of whether they are going to be micromanaging you or whether they are going to be partnering you. Because as an entrepreneur, you want enough empowerment and a very supportive investor. And the way you do figure that out is by talking to their prior investee companies and figuring out as to whether they are micromanagers or whether they are going to be a supportive investor who will bring interesting perspectives, but let you make the final choice. So these are a few that come to top of my mind.
Okay, another question is that what should founders be mindful of and what should they avoid doing or not do while making a pitch? 2 or 3 golden rules here. What should they not do while pitching?
Yeah, I think investors have very low attention span because they look at a lot of portfolio companies. To give you an example, a typical Series A investor probably looks at about a couple of thousand companies in a year and invests in 30, 40 companies. So you need to keep your pitch very, very concise and very crisp. And in your first or second slide, answer 3 questions. Why this? Why this means why this particular idea? Why you, which is how you are best suited to execute on this idea? And why now? Why is it that the time has come for this idea to thrive? So I think if these 3 whys are addressed very early on in the presentation pitch, then the probability of their staying attentive and focused goes up very, very significantly. And the other thing is be very authentic in your input, because investors get a lot of data from a lot of sources. So if they find that you are not being truthful, then I think that will hurt your credibility a lot. So I think those probably would be the top 2 to my mind.
So in addition to all of these crucial ideas for a startup to look more worth investing in, are there some frills that matter as well, or some other pointers which may not be what people usually prepare for? Experientially, have you found some, not frills is the wrong word, any other indicators which may not sound logically to be linked, but you've learned that they matter? Any signals?
That's a tough one. Things that they should be wary about.
See, for example, I'm just going back many years after we had listed and companies were listing.
Yes.
And there was a friend of mine who doesn't know anything about our sector. He asked me a question one day. He said, he's planning to make an investment, but I just heard the founder of that company just bought a very expensive car. So now I'm thinking of not investing.
Yeah.
I mean, it's in a bit of a lighter vein, but like that, what are some indicators which scare away people or which give people the confidence in addition to what is in the pitch?
Yeah, I think one very important question is how much salary will you pay yourself? Because that tells you whether the founder is coming to create long-term value, or is he still in an employee mode where he's hoping to satisfy his financial needs through compensation. So whenever
You've seen that
founders,
correlate. You have seen that correlate in your experience?
yes, whenever founders are seeking very high compensation, that's a red flag, because that's very clearly a misalignment of interest. Because in early stage, money is very, very valuable. And if that money is being spent in paying high salaries, then obviously it's not a good start. So I think that probably is one. And I think two, investors also don't like people bad mouthing competition. So I think one of our favorite question is competitive context. So a lot of people would put themselves always in the right top quadrant and rubbish the competition. Though a better way would be to really illustrate strengths and weaknesses of each of the peers. So I think that is another very good indicator that are you objective and are you truthful about the way you are building the business. The third one, Raji, is that when you ask a question, what would you do if you were not financed by us or by anybody else? If you get a very, very good articulation of that, then that's also a red flag, because that means that your conviction about this idea is weak. And at first blush, you will actually move to something else. While for all of us, you being committed to what you do is very, very important.
Okay, now the last thing. It's coming from a question that someone has asked to one of our participants. How can we make EdTech ventures accountable for the actual learning outcome? Where does that fit into your thinking? How do we?
I think that actually, yeah, sure. That goes back to net promoter score and market forces. I think if any consumer is coming to your platform and you are not delivering the value that you promised, will reflect poorly on your NPS. And that impacts everything else. You won't be able to raise investor capital. You won't be able to get people. So I think market forces will take care of that, to my mind, that you stick to your promise, because India is a very efficient market. And if there are any missteps in execution, and by execution, I mean delivering on the metrics which you promised to, then there are a lot of people waiting on the sidelines to enter your business. So that's how I think about this, that you will have no option but to, there will be so much pressure from your board, from your employees, from your customers to do the right things. Otherwise, you will not survive.
So finally, now summarize for our youngsters or many startups, just to round things up, the three most important things out of what all that you've said.
I think number one is first principles thinking. because entrepreneurship is all about navigating ambiguity. Number two would be complementary skills in a team, what I said, Brahma and Vishnu. And number three would be pursuing a market which is at least $10 billion in TAM. TAM being total available or total addressable market. So I'd probably pick those three as my top three.
Wonderful. I think this has been very educative. So thanks so much, Sanjeev, for finding the time. This is, as you know, this whole program from 2:30 till 6 has a series of sessions. And yours was pretty much the first panel after I gave a little overview on past, present, and future. And these ideas, which we'll be dealing with during the course of the day, are also going to be very helpful. So thanks for kicking it off with some very sound, easy to comprehend ideas, which I'm hoping that everybody will embrace. So with that, Neha, back to you.
Thank you, sir. It was indeed very insightful